Let's focus fully on earnings now. First, Federal Bank, their numbers came out in trade yesterday, and the provisioning came to good use in the third quarter as slippages increased. Recoveries were higher, as did cost to income ratio. Joining us now to talk about the earnings is the bank's MD and CEO Shyam Srinivasan and Shefali Malik Johnson to take that conversation forward. Shefali.
Well, yes, for Federal Bank, the numbers were quite okay. They had higher recoveries as well and even higher write-offs to the tune of 300 crores. So I asked all these questions. So I'll be asking all these questions to the management. So Mr. Srinivasan, so on the backdrop of a weak macro environment, what were the factors that worked for you this time and what didn't?
Yeah, hi, thank you. Like I mentioned in our sort of press release after the results, we're quite encouraged with our Q3 overall outcomes, because there were three themes that we were keen to ensure that the quarter delivers. One is we've seen opportunities to sort of calibrate and grow our retail, which is trending well. At the same time, be a little more cautious on the overall corporate, given the external environment still continues to be a little sort of dodgy. The third is knowing that two large housing finance companies which are on our portfolio have challenges, and recognizing them as NPAs, how do we make sure that the overall slippages for the quarter continue to be very good? And I'm pleased that if you back those two accounts, which we knew are challenges and we had already made standard asset provisions last quarter, we want to ensure that this quarter the overall slippages are contained well. And I'm pleased that outside of these two accounts, our overall slippages were at a multi-quarter low. And that happens because for now 10, 12, 14 quarters, the credit growth that we've seen have been in the segments we want, from the kind of security we want and the sort of ratings we want. So we believe that irrespective of the environment, we've been able to contain both the outcomes and ensure that the going forward also is sort of well protected. So I believe that overall Q3 is quite on track. Growth is muted in corporate, but retail and other businesses have grown 20% plus. So more or less along the lines we would like it to be. I would have been happier to see some more corporate growth, but we are being extremely watchful.
So these two housing finance companies that you talked about, is there an adequate provisioning cover, or do we expect more to come in the next few quarters?
It would depend on the resolution outcomes. One of them is there's an RBI appointed administrator activity going on. A resolution professional is working on it. We should see how things shape up over the next 3-4 quarters. The other is an account which we've increased our provisions, and we believe that if the resolution kicks in and the same level of intensity is put in, there is a certain degree of recovery option. But my own belief, over the next 2-3 quarters, we will increase our provision to at least 40-50% to make sure that should there be some impact, we should be able to well cushion. So it's a 2-3 quarter kind of work, depending on the resolution and depending on the way things shape up over the next 2 quarters.
So what is the outlook then for the asset quality going ahead for both corporate and retail, and within corporate the MSME book, and for retail as well? We are seeing the noises increase across the sector that the delinquencies are going up, might go up from here on. So what is your outlook?
Our book is largely a secured book. We don't have a big unsecured component. And so there is a sense of how things will shape up over the next 2-3 quarters. We're quite reasonably confident that the current run rates that you're seeing should hold, with some marginal band up and down, but nothing that will shift the dial materially. And on the corporate side, we don't have any big names, and I'm hoping nothing comes up in the coming quarters. So as of now, our outlook looks quite positive as of now, and how we think the next 2-3 quarters should shape up.
So you've undertaken write-offs as well in this quarter to the tune of 330 crores. So which accounts are these, and are there any recovery prospects here?
Yeah, one of them was a large account which is in the power space. It was about 200 crores and we decided to write it off by providing 100% on it. There are some recovery opportunities, work is underway. We will see how that shapes up. These things, there is no sort of certainty when it will happen. We know that it will happen because in that power generation space there is some traction which is positive, but I can't quite tell whether it will happen in Q4 or Q1 of next financial year. But all I can say is we're in a better place than we were because we're fully provided, so anything we get is an upside.
So going forward, where do you see growth coming from? Which would be the pockets of growth for you?
No, I think there are two parts to it. One is the external environment conducive for growth, and the second is where we are growing. If you take our 13% Y on Y and split it, retail and gold have grown 25% plus. Our business banking business has grown 17%. Our commercial banking and corporate banking have had much lower growth. So you can see that the segments which are more retail in nature are growing and will continue to grow for us because we are gaining share. On corporate and commercial banking, which are bigger ticket, the risk appetite needs to be higher, and we are being very watchful there, and I'm not keen to step very hard on that, so that that requires some environment pickup. So our blended credit growth for the year may be around 16-17%, and that's still about almost like 1.5 to 2 times the market credit growth. Thereby we are gaining share, and that also sets us up for FY21, and as the environment picks up we should get back to our 18-20% kind of growth rates.
So one positive in your earnings was the improvement in cost to income ratio. Is there a likelihood of further improvement going ahead?
Yeah, this quarter it improved about 100 basis points over the previous quarter. We are working to ensure that improves further by another 100 basis points. The only variable would be the pensioning requirements that may come up should yields move one way or the other, and that's something that not really in the hands of the bank. So we are working on other elements for efficiency and productivity, like we have done, because we have a full-fledged our own ops company which is doing a lot of centralized automated processes. The level of RPA and AI based activities that are going on are all improving the overall productivity of the bank. So I believe that in the quarters ahead this momentum should continue, and as income improves the cost income ratio is bound to improve. The only one would be around the wage and pension related, which unfortunately is not very tightly managed by us. There are external factors too.
So just one last question. So what is the likely trajectory for the margins from here on?
We think we will be getting closer to 3.1 in the last quarter, and a full year of about 3.07 or so, or 3.06 to 3.07, and that run rate is what we will start building into FY21 to ensure that the margin expansion comes back, and we will push for another few basis points increase in the following financial year.
All right, Mr. Srinivasan, thank you so much for joining us, and all the best for the quarters also to come, sir. So, Neeraj, that's Federal Bank. Their numbers were actually quite stable this time. They delivered on most metrics apart from the corporate slippages coming in this quarter. Apart from that, the numbers were pretty decent.
Yeah, and I think we spoke about this yesterday as well on Countdown, that while there was an initial reaction and it did seem that the slippages were higher and therefore the markets took heed of that, but then we did an explainer on why the numbers didn't look all that bad also, because a lot of other metrics seemed okay. And the stock has duly gained. Shefali, thanks so much for putting that into perspective.